The year 2019 still may, and the IMF was in both of those, I think, still may be one of the fastest global growth years on record. And America, which is a big part of the global economy, is growing at 3% plus, and it's just powering through. People coming back to the workforce, wages are going up, companies are spending more in capital expenditures, confidence is very high.
All right, that's Jamie Dimon at J.P. Morgan Chase. Remember, that's the same company that Warren Buffett's Berkshire Hathaway has a $4 billion investment, and he added to that. Let's get to read from market watcher Jim LeCamp, a similarly financial astute brain. Jim, you're looking at this and you're hearing Jamie Dimon, one of the most respected financial CEOs on the planet, saying, I don't know, I've heard all this talk about slowdown, but I don't see it happening next year. Do you agree?
Well, he's clearly not looking at the same data, Neil, that I'm looking at. Now, I hope he's right and I'm wrong, but I don't think so. Because when you look at German growth in the last GDP quarter, you look at Italian, Japan, all the growth, the GDP prints we're getting around the world are already showing deceleration. If you look at any of the growth rates for the G7 countries, the developed markets, the emerging markets, they're all projecting at a little less rate next year than this year. You still have growth, but you're seeing deceleration everywhere. And not to mention the soft data, which are all the surveys, the purchasing manager surveys, the manufacturer surveys, and the hard data. Both of them are showing deceleration at an increasing rate. So I don't know what he's looking at. We are still expecting growth. I'm still seeing growth not only here but around the world, but we're not accelerating, we're decelerating, and there's real concerns that if we don't get these trade wars taken care of, that this deceleration will accelerate.
I like the way you explain it. Deceleration will accelerate. There is some truth to that. I'm wondering how important it is then to score a deal, or at least the construct of a deal with China, to you.
It's real important. What we've seen, particularly with a lot of the technology companies, is that some of the imports that we've done in this country have been front-loading to avoid the tariffs. Well, what that does is it leaves a void in the future. And if we continue to see these tariffs build up, these talks build up, hopefully they're getting better. I think they will. I think they'll get solved. But there is so much uncertainty that we hear from these business owners. Jamie Dimon talked about core capital expenditures. A lot of that was in the oil patch. And I don't know if you've seen oil prices lately. It doesn't suggest that they're going to ramp up spending from here. Yeah. So I think there are a lot of issues that are not really showing up in the data yet, but will show up. And the uncertainty around these trade talks will only make things worse. We're already seeing some of it show up in the supply chain. It's not terrible yet, but it will only get worse if we don't get resolution.
You know, real quickly on oil and the collapsing prices, I was looking at the half full glass, maybe naively of that frees up more money for consumers, for shoppers, particularly this holiday season. And that's a net good. Now, I quite understand the impact it's going to have on the industry, even here in this country. But for most others, saving that money at the pump and heating oil prices and the rest, that could be the beginning of an economic boomlet, or am I naive?
No, I think you have it right, Neil. Look, it's a muddier picture with oil than it used to be because it was a big source of our job creation in this country, particularly on the mining sector, big source of our capital expenditures. On the other hand, net, it does put more money in the pockets. It does make input prices cheaper. It's a positive for the economy. So the other thing I want to point out here, I don't want to sound too negative, because we've never gone into a recession with consumption on the increase, and consumption is on the increase in the United States. We've never gone into a recession with leading and coincident indicators pointing north. They're not pointing as north as they were, but they're still pointing north. So I'm not suggesting we're going into a recession, anything like this. I'm saying the notion that next year is going to accelerate above and beyond this year, it's not showing up in the data. In fact, quite the opposite.
Jim, thank you. If we don't talk again, have a wonderful Thanksgiving, my friend.
You too, Neil. Great to see you.
Jim LeCamp, very fine financial read of things.
Into a recession with consumption on the increase, and consumption is on the increase in the United States. We've never gone into a recession with leading and coincident indicators pointing north. They're not pointing as north as they were, but they're still pointing north. So I'm not suggesting we're going into a recession, anything like this. I'm saying the notion that next year is going to accelerate above and beyond this year, it's not showing up in the data. In fact, quite the opposite.
Jim, thank you. If we don't talk again, have a wonderful Thanksgiving, my friend.
You too, Neil. Great to see you.
Jim LeCamp, very fine financial read of things.
Neil, great to see you.
Jim LeCamp, very fine financial read of things.
At this point, a lot of people are looking for economists who saw the last downturn happen before it happened. And one of those people is Harry Dent, the great economist who joins us now by phone. And Harry, I imagine you're looking at this and thinking to yourself, I knew it would happen sometime, but I'm wondering if you think this is really when it's beginning to happen.
Well, you know, we've been telling the people that follow us that you know, we're getting we really turned bullish when Trump got elected. We knew the gravy train was coming and tax cuts, and you can't argue with that. There's nothing better than tax cuts and repatriation. But again, it's a
and deregulation
short-term thing. And we've said, look, this is the final blow-off rally. The question is, how long does it last? We've been warning our people that, look, there's a high chance that we're going to peak late this year, and now this is the first sign of that potentially. Or if we can keep to a 10 to 15% correction, we could have one more run up in the next year. But the odds are shifting very quickly to this could be it, because we
okay,
really
now hold on a second, Harry, because you throw out numbers here.
I
just want to make sure
the bubbles are off the charts.
Okay,
and so this could be the beginning. Here's the trick, and it's very difficult when bubbles burst, and we've researched every major stock bubble in the last century. The first whack is 40% on average in 2 to 3 months.
40%.
So the problem is it's almost better to hedge. We're telling right now options are cheap. It's better to hedge your portfolio than necessarily get out. But it's better to hedge or get out early, because once this thing happens, it'll happen so quick that people won't know it.
Okay, Harry, I wasn't sure if you could hear me, but the fact is that what you're suggesting is a kind of immediate downturn in the market like I don't think we've seen in decades. What do you think is the cause of this? Is it the fact that we've had these zero interest rates, these artificial zero interest rates for a decade all around the world, and finally the chickens are coming home to roost, or what is it?
Yeah, absolutely. This is the first and only purely artificial long-term rally, and now it is the longest rally in history without a 20% correction. I mean, our demographic factors peaked in late 2007, as we predicted would happen decades before that, and the economy got weak, and the real estate bubble burst. We predicted that just months before it started going down in 2006, when Ben Bernanke said, oh, this is no problem, this is containable, this little subprime crisis thing. So the fundamentals, including geopolitical. We have a geopolitical cycle that has been down since 2001, 9/11, and does not start to turn up until about a year and a half from now. So all the cycles we have are down, and yet the economy's gone up anyway. Why? $16 trillion of money printed, and now trillions of tax cuts, $2 trillion repatriated to the United States. You know, we're the only market in the world making new highs because of the Trump tax cuts. Europe and them have not made new highs. That's another divergence. Also, emerging countries, the emerging markets are down 22%.
Well, I know that's partly that's because of the problem with the IMF. The IMF has been giving them the wrong medicine. Harry, I'm sorry, I don't know if you can hear. I think we're talking over each other there.
If it does, we will probably see the market down 40% by December or January.
Harry, I'm sorry, we're having trouble hearing each other and talking over each other. But two things I would say to you, and I want to get these 2 points in and then give you the final word. One is the fact that the emerging markets are going down primarily because they're getting terrible advice from the IMF telling them to raise taxes, devalue their currencies, do all the wrong things. But secondly, do you completely discount the power of the tax cuts, which did revive tremendously not only the corporate profits, but also corporate investments in, among other things, payrolls, hiring people and training people. Also, the amazing amount of deregulation that's going on, and the fact that you have as president a businessman as opposed to an academic who doesn't much like business.
No, again, we turned bullish with our subscribers that, you know, the day after the election when Trump got elected, we knew it was going to be pro-business. We knew that's going to be another short-term stimulus on top of 9 years of free money and quantitative easing. But again, we're in an economy where we're running out of workers to hire. The workforce is projected to not grow at all in the next decade. Productivity's gone from 3% plus down to 0.5% because the aging of the workforce and baby boomers. Fundamental trends are going in the other direction. So, yes, stimulus short-term always works, but we don't think this works past the next year. My question is this the top, or do we see a top by late 2019? Either way, I see the biggest crash of our lifetimes coming in the next few years, and this could, the odds are, you know, this has got more to show. This is not enough yet. The problem is, again, the first crash after a bubble like this is 40% in the first 2 to 3 months. So if you hang in there to see if it's going to go down, you get whacked really hard.
Okay.
Really quick.
Well,
That's the problem.
other than that, I think you think everything is rosy. So everything's.
Well, I would look, I mean, we've been bullish for most of my career because we saw the baby boom coming, saw the internet coming, and all this sort of stuff. But every boom goes to extremes, and this has been a bubble. And then you have to correct. We have too much debt. Financial assets are overvalued. The poor millennial generation will never be able to afford to buy a house and make money off it. Never be able to afford to invest for the
You'll
future
ask me a
at such
poor
high
millennial.
valuation. So
Yeah.
a correction, a big
Harry,
correction over the
I'm
next
so
years
sorry to
would be
do this,
very
but you're
good
going to have to cut him
long-term
off because
for
I don't
our
think he can
economy.
hear
I
us.
mean,
So, Harry Dent, you've been right before. It is important for everybody to listen to everything you have to say. You may not be right this time, but that is one end of the argument. Harry Dent, great to have you on.
Odds are, this has got more to show. This is not enough yet. The problem is, again, the first crash after a bubble like this is 40% in the first 2 to 3 months. So if you hang in there to see if it's going to go down, you get whacked really hard.
Okay.
Really quick.
Well,
That's the problem.
other than that, I think you think everything is rosy. So everything's.
Well, I would look, I mean, we've been bullish for most of my career because we saw the baby boom coming, saw the internet coming, and all this sort of stuff. But every boom goes to extremes, and this has been a bubble. And then you have to correct. We have too much debt. Financial assets are overvalued. The poor millennial generation will never be able to afford to buy a house and make money off it. Never be able to afford to invest for the
You'll
future
ask me a
at such
poor
high
millennial.
valuation. So
Yeah.
a correction, a big
Harry,
correction over the
I'm
next
so
years
sorry to
would be
do this,
very
but you're
good
going to have to cut him off because
for
I don't
our
think he can hear
economy.
us. So, Harry Dent, you've been right before. It is important for everybody to listen to everything you have to say. You may not be right this time, but that is one end of the argument. Harry Dent, great to have you on. Harry Dent, you've been right before. It is important for everybody to listen to everything you have to say. You may not be right this time, but that is one end of the argument. Harry Dent, great to have you on. Harry Dent, great to have you on.